We're not making a ton of money at this particular point in time.
Air New Zealand CEO Greg Foran on a 65% profit drop. He fights back against claims airfares have been sky high.
If it appeared that we were making lots of money on our domestic business, my profit would be a heck of a lot higher.
He talks staff cuts.
We've been quite surgical about how we've done that.
Why $1 billion worth of planes are grounded.
I don't like it. I wish that I didn't have to deal with it.
And takes aim at the government for jacking up fees for tourists.
I would suggest to you that it is certainly not helpful to getting tourism back on its feet.
Welcome to NBR's Back in Business podcast. I'm your host, Simon Shepherd. Kiwis have a love-hate relationship with Air New Zealand. They have a sense of loyalty and pride when it ranks well internationally. Yet when prices skyrocket and it's cheaper to fly overseas than to Rotorua, there's a sense of betrayal. Navigating public perception, volatile fuel prices, grounded planes and a big drop in earnings is the job of CEO Greg Foran. I'm going to try and get through this interview without using the word turbulence. So let's go with tough times. Earnings down 61%, profit drops 65%. Are you happy with the airline's performance?
It's as expected, to be frank with you. Obviously we forecast out where we expect to be. The first half was better than the second half. The second half got increasingly difficult. We know why. So to come in with the number that we came in was, just a bit north of sort of the midpoint of guidance, and it's where we expected.
You've had to take costs out of the business, which includes staff members. So staff reductions, 400 in this past financial year.
Yeah, that's really been over the last few months, and we've been quite surgical about how we've done that. As we saw conditions start to tighten up, we had a look at areas, and there's actually a couple of areas where we increased numbers. One of those have been cabin crew, and the other one has been in our engineering and maintenance areas. But in other areas of the business, we've been able to take some heads out, and so we've just got on and done that over the last 3 months.
I just want to ask about one of the lines in the financial reporting, which is the outstanding travel credits. They were issued as a result of the pandemic, worth about $90 million, and they're included as passenger revenue, even though they haven't been used. Is that right to count them as passenger revenues?
Yeah, we think it is. And, this is, if you like, the breakage of what's outstanding. So we don't believe that these are going to be picked up by customers. And there could be a number of reasons for that. So to put a little bit of context around it, there was something like about 1.3 billion worth of credits given over this period. Yep. And over 90% of those have been redeemed by customers. About 6 months out from someone's credit falling due, we get in touch with them. 3 months out, we get in touch with them. 6 weeks out, we get in touch with them. 2 weeks out. We do various other things. We've contacted every customer who has more than 5,000 in credit personally. Right. There are some people who unfortunately will have passed away over the last 5 years, okay. And there'll be another group who have already got their credit through insurance. So, we sit down and we look at that from an accounting perspective and we say, well, look, there's about $90 million that we don't think is going to get redeemed, and so that's been included in the revenue.
Are you satisfied Air New Zealand has done everything possible to try and get people to redeem those credits who are owed those credits?
Totally. Yep. There's been a lot of communication, as I said. Remember that, when this really kicked off, it's now coming up 5 years. Yep. So by the time we put a stop on this, it will actually be 6 years with a 7th year left for someone to travel. I think that's very reasonable.
We know the credit system was not as smooth as it should have been.
By comparison, Aussie competitor Qantas, which did have an expiry deadline for its COVID credits, backtracked.
These credits and vouchers will never expire.
Qantas removed the expiry dates on its COVID-19 credits and offered the possibility of a cash refund. Jetstar has taken away any time frame for the user credits. So why has Air New Zealand not done that?
We adopted a different position to begin with based on the conditions of carriage that are available in New Zealand versus Australia, and have been really clear with customers about what we're doing, being very fair. During this period, we've given people money back where they needed money back if they were suffering hardship. So it's not quite apples with apples. I think we've been very open, transparent, very fair. At some point you have to bring a close to these things. You just can't have it sitting on your balance sheet forever and ever and ever. So I think by the time you get to 6 years, time to move on.
One of the big revenue issues for you is the number of planes sitting on the ground. 10 planes worth $1 billion not flying.
Yeah, and it's tough, isn't it? And because it really depends on what were decisions that were made around engines and fleet many years ago. If you decided when you would put it, if you decided to have a fleet of Dreamliners, you got a choice of 2 engines. Did you go with a GE engine or did you go with the Rolls-Royce engine? We went with Rolls-Royce. We made that decision in 2004. The first plane arrived about 2013, 2014, and since 2017 we've had ongoing challenges with the Trent engine. So these are things you have to deal with. Proud of the way the team are dealing with it, but it has an impact on the financials. Hard costs of around about 100 million we know for last year. Soft costs about another 50 million on top of that.
This has obviously caused scheduling issues, all sorts of capacity issues, those kinds of things. Has it caused you reputational damage as well?
Oh, for sure. There's 2 things that this has created. One of them is disruption. So, we're having to work the existing fleet quite hard to try and maintain the schedule. We're doing twice as many engine changes as we used to have to do. And so that puts pressure on the system. It means that sometimes we're having to change out a plane from a 777 to a 78 to an A321, etc. That creates issues for customers, and it also creates challenges around the ongoing on-time performance of the business. I don't like it. I wish that I didn't have to deal with it.
Yep.
Most importantly, I wish our customers and our staff didn't have to deal with it, but we do. And time will pass.
When will time pass? When are you going to get all of those planes back and operating? Do you have a time frame?
2 to 3 years.
2 to 3 years still?
Yep.
So does that mean the schedule is going to be disrupted and the capacity is going to be disrupted for another 2 to 3
Well, no, we hope not, because we hope that at the end of next year we start to get delivery of some new planes from Boeing. And we know that about May next year we get a further 2 planes from Airbus and a further 2 planes from ATR. But it does continue to put some pressure on us financially, so we have to deal with that. And it seems like an awfully long time, doesn't it, in terms of,
It does, yeah.
why can't you just fix this, Greg?
Yeah.
It's, get on and do it.
Greg, fix it.
Exactly.
Get the spans out.
And, the best way I could describe it is that you can imagine there are millions of parts on a plane. And those are made by thousands of suppliers around the world. They're not all run by Rolls-Royce or General Electric. They contract those out to people. If you happen to have a plane and it doesn't have a Pratt & Whitney 1100 on it, which happens to be a very new engine, because we like to have new fleets, and you're running an older engine, you're actually okay. It's a bit like that old Toyota Camry you might have in your garage versus a Tesla.
Right.
One of them is going to keep going and the other one needs servicing. So we have to deal with that.
Yeah.
It'll get fixed.
Fixing those planes and eventually taking delivery of 2 new Boeing Dreamliner jets at the end of 2025 should see scheduling and capacity nightmares ease. But that means the climate has suffered as a result. Holding on to less efficient planes combined with a lack of sustainable fuel has forced the airline to abandon a climate goal to cut 29% of emissions by 2030.
I'm not sure exactly where we're at by emissions by 2025. What I can tell you is that for us to hit the goal that we had, we needed to be at sort of 17% sustainable aviation fuel by about 2030, based on the assumptions we have at the moment. So those are still going out 5 years. We felt a bit uncomfortable with that. We're trying to get to 2% this year, and then we needed to get to 17 by 2030, and we said, that's a pretty high hurdle to get up. We think it's appropriate to take a pause on that, which is why we pulled it, and let's reassess where we're at.
While the airline reassesses, there's another economic headache on the horizon. Yes, the economy has been doing it tough, yet Greg Foran has some good news.
I think we're at the bottom of the cycle.
Along with some bad news.
But I do see a headwind coming. Tourism.
Right. So you want to talk about the tourism levy?
I do. I'd love to talk about the tourism.
So you say tourism is an issue because we're only about 80% of pre-COVID levels.
82.5 last time I looked.
Yeah. So and now we're going to charge them another $100.
Well, that's only for the IVL. If you need a visa to come here, it's another $200.
Yeah.
If the CAA put their prices up, which they probably can justify because they haven't moved, that'll be some more. We're already dealing with airport increases.
I was going to talk about that as well. So what are you saying? The overall
The collective increase on the ecosystem is not going to be helpful. And I think we need to consider that. Each component individually can justify what they're doing. It's a collective experience of this. Ultimately is going to stifle demand. It has to.
Tourism Industry Association modelling shows that $100 levy could reduce visitor numbers by 48,000. Is that a big hit for Air New Zealand?
When you consider that about 20% of that 48,000 also come in and get on the domestic network, so they fly into Auckland and jump down to Queenstown or go to Christchurch or Nelson to go around the vineyards, yeah, it hurts. So, you've got a domestic business at the moment which is dealing with government spend down circa 28%, corporate spend down 10 to 12, SME down 10 to 12. Add in what's coming with tourism, and we've got to work hard on this, don't we?
You've had the minister and previous ministers like Stuart Nash come out and say, come on, $100 isn't that much. It's not going to actually have that much of a dent. So what is your message to those decision makers?
Look at the total, add it all up, and ask yourself, as a customer, what is the difference between what I was paying to what I am paying, and is that an acceptable and digestible increase? I would suggest to you that it is certainly not helpful to getting tourism back on its feet, and tourism is a big deal for this country.
There's another cost factor that will also push up prices.
So while the airport has served us well, it's time for a big upgrade.
Air New Zealand and other airlines have been in a long-running spat with Auckland Airport over the cost of its $3.9 billion upgrade.
How concerned are you about that backlash from airlines like Air New Zealand?
Well, look, we have consulted extensively with the airlines. Ultimately, we believe that it is the right thing to do to get on and deliver this integrated terminal for Auckland.
And how that cost is going to be passed on to airlines. Do you still say that if they go ahead with these charges, it's going to increase ticket prices by about $40?
The simple answer to that is that our modelling indicates a number similar to that.
Yeah.
Obviously, Auckland Airport have come out with a number that's a bit different to that. We have to make assumptions, they have to make assumptions. Call it halfway. Once again, it's another increase.
Right.
And our beef is not actually with the airports. The airports are simply following the regulatory environment that was put in place in 1986. We would like the Minister and the Commerce Commission to review that regulatory setting. We don't think it's appropriate in 2024, particularly when you're dealing with a significant generational spend that is occurring at the moment. We think there needs to be something a little bit more robust in the way that that spend is agreed than simply, we're going to consult with you about it. We think there should be some ability to either negotiate and arbitrate or potentially have some sort of price setting event.
Because you don't think it's fair you're being dictated to.
If we don't agree with what needs to be spent, it's sort of too bad. I would say they have a very good monopoly over us. Difficult for us to land our planes anywhere else. In terms of Auckland Airport, very important we have a good relationship with them, and they have with us.
Yeah.
We're over 50% of the volume in there in total. We will look for some support, down in Wellington to have a look at the regulations.
The Airports Association, in return, has come out and said the problem is domestically. It's the pricing of Air New Zealand.
And I would say that if I was them too.
They say it's costing Kiwis and needs someone to look at this. So I wonder, what do you think of calls for a market study into the domestic aviation market?
So let's go back to how this discussion began, because that's possibly a good start point, isn't it? So we've finished 6 months worth of, or 12 months worth of trading in New Zealand. Different environment to the year before. And take the $90 million worth of credits off the $222 million in our net profit for the organisation is $130 million, carrying billions of dollars worth of assets. Ask yourself, is the return on invested capital for Air New Zealand last year acceptable?
Right.
And the answer is, it's not.
No. So
we needed to make more money. How could I make more money? I can either put my prices up or take my costs out. So I would say to you, if it appeared that we were making lots of money on our domestic business, my profit would be a heck of a lot higher. You might say, well, hang on a minute, you're making all this money on international routes.
Are you?
Well, there's 32 airlines, 32 flights a week that fly in here from China.
Yeah.
Do you think I'm making lots of money when I have that?
There's a lot of international
There's
competition.
52% more seats this year flying in from America than there is normally. Not 10% more, 52% more. So ask yourself, am I making lots of money in this highly competitive environment internationally? The answer is no.
This is a fraught area for Air New Zealand. Kiwis often complain about domestic prices, especially if booking regional routes or booking late. Air New Zealand is often fighting off claims of sky-high pricing. Just this past July, Consumer New Zealand did a comparative analysis. They took 11 flights in 2023 and 24 and compared them with equivalent flights in 2019 and 21. And it says it found price increases ranging from between 34 and 297%, which sounds staggering. So how do you respond to that?
I would say to you, they're a commercial business looking to help sell subscriptions.
So you don't believe their methodology? Is that what you're saying?
I have no support for their methodology at all.
Greg Foran instead points to Stats New Zealand figures, which show domestic fares rose 47% for the 4 years from quarter 1 2019 to the first quarter of 2023. And to compare, Air New Zealand says its cost base has seen inflation of 20 to 25% over the past 5 years.
Airline pricing is fraught with all kinds of challenges in terms of how you want to measure things. Here's what I can tell you. Our average price in July this year for the month versus July last year for domestic, including jets and regional, was down 5%. Yet my inflation is up 5% on wages and about 7% on non-wage areas. So that's one of the reasons that the profit is what it is. So pricing, July versus July, is actually down 5% on average. Now, for sure, you can go out there and find someone who said, well, I'll tell you what, I booked a flight on Wednesday, a day's notice, and I had to get down to Wellington and I got charged $450 one way. If you book very late, that tends to be what happens. If you book ahead of time, you can get very reasonable fares. Our pricing actually is very fair and moderate. But I do appreciate New Zealanders are going through a challenging time. Many are at the moment. Mortgages are up. All you have to do is look around the place. So I'm not denying it doesn't cost you to fly. It does. We're not making a ton of money at this particular point in time. We're very conscious of keeping the thing going and the volume going. Our numbers, Department of Statistic numbers, indicate that actually pricing is not anything like the Consumers Report would indicate.
The New Zealand public seems to have a sort of love-hate relationship with Air New Zealand. They love to travel Air New Zealand. Air New Zealand rates really well in year on year on corporate trust surveys and global airline rankings. The public puts the boot in when things go wrong, and that's a real challenge for you. So how do you marry up those two kinds of things? And can you ever do that?
So the first thing is you have to accept that that is the situation. You know, we have 5 stakeholders that we have to manage, like any business does, but it's at an elevated pitch all the time. So, you know, whether it's customers, our staff, the communities in which we operate in, our suppliers, and of course our shareholders. And our shareholders are even a bit more complex because it's everyone in New Zealand, because the government owns 51%. And then there's your more traditional shareholders, and I personally am one of those myself. So I accept that we get held to a high standard and we have to hold ourselves to that standard. And it means you've got to be very thoughtful about the decisions that you make in terms of things like pricing, things like customer experience. How do you invest in new uniforms and when do you do that? How do you think about safety videos? And all of those things means that it is quite a complex business to run, but I enjoy the challenge of that. And I know that at the end of the day, we will be judged on how well we operate across all of those stakeholders. There's no point in just winning with one particular group. You need to ensure that you operate with all.
Can you win across all those groups, or is that an impossible task?
Well, I would say to you that in most organisations that I've worked in over the years, what tends to happen is that you will tend to invest more in 1 or 2 groups for a period of time. You know, we've got to make sure that we can generate the appropriate returns in this business so that shareholders are rewarded. They've done it tough now for a period of time. It's unfortunate we've got some of these sustained headwinds, but I'm comfortable that we're building a business here with a very strong foundation. They will see the rewards.
And that wraps up this episode of NBR's Back in Business podcast. Audio clips used are listed in the podcast description. For more breaking and comprehensive business coverage, head to nbr.co.nz. Thanks to Creative Director Michael Hickmott and Content Producer Joseph Hisayasu. Our next episode drops on Thursday. I'm Simon Shepherd. We'll catch you then.